In the intricate tapestry of global economics, few commodities hold as pivotal a role as oil. Its influence permeates every sector, from transportation to manufacturing, making it a cornerstone of industrial and economic development. This essay explores the dynamic relationship between oil demand and economic growth, highlighting how oil consumption both drives and mirrors the health of global economies. By examining historical data, current trends, and future projections, this analysis sheds light on the dual role of oil as both a catalyst for prosperity and a bellwether of economic change. Oil has long been a cornerstone of industrial and economic development, serving as the lifeblood of modern civilization. Its discovery and subsequent exploitation have catalyzed rapid industrialization, transforming agrarian societies into industrial powerhouses. The role of oil became particularly pronounced during the 20th century, when it underpinned the massive expansion of both the automotive and aviation industries. The story of oil as a growth enabler can be vividly seen in the United States, where the Texas oil boom at the turn of the 20th century heralded an era of unprecedented economic growth. The surge in oil production fueled a burgeoning automobile industry, epitomized by Ford's Model T, which was introduced in 1908. This vehicle, affordable and mass-produced, became a symbol of American industrial prowess and economic expansion. The demand for oil products, particularly gasoline, surged as a consequence, reinforcing the link between oil availability and economic growth. Similarly, the Middle East's transformation, particularly Saudi Arabia, from relatively poor nations to economic titans within decades, underscores oil's impact. The discovery of oil in the region in the 1930s, followed by increased extraction post-World War II, turned these countries into principal players in the global oil market. The wealth generated from oil exports was pivotal in modernizing these economies, building infrastructure, and elevating the standard of living for their populations. Moreover, the economic prosperity fueled by oil also led to significant advancements in technology and human capital. Countries invested in education, health, and technology, further driving economic growth. The causal relationship between oil exploitation and economic development is evidenced by increased GDP, higher employment rates, and enhanced industrial capabilities in these regions. Despite these benefits, the reliance on oil has also introduced elements of vulnerability. Economies heavily dependent on oil revenues face challenges of volatility in oil prices, which can lead to economic disruptions. Nevertheless, the historical narrative remains clear. Oil has been a fundamental enabler of economic growth, providing the energy required to drive industries, transport systems, and ultimately, global commerce. The correlation between oil demand and economic growth is a well-documented economic phenomenon, reflecting a direct link between energy consumption and economic activity. Oil, as a primary energy source, fuels almost every aspect of modern economies, from manufacturing and freight to agriculture and personal transportation. Therefore, changes in oil demand often mirror shifts in economic performance. Statistically, this correlation can be evidenced through various economic models and empirical research. For instance, regression analyses involving data from multiple countries over several decades frequently show a positive correlation between increases in oil consumption and GDP growth. Such analyses typically account for variables like industrial output, population growth, and technological advancements, still consistently demonstrating that oil demand growth is closely tied with economic expansion. Economists often use oil consumption per capita as an indicator of economic development. Higher oil consumption per capita is generally associated with higher income levels, as seen in developed countries like the USA, Canada, and parts of Western Europe. Conversely, emerging economies, which experience rapid industrial growth, often show significant increases in oil consumption, highlighting its role in economic development. Moreover, the elasticity of oil demand concerning economic growth can be observed during economic booms and recessions. During booms, increased industrial activity, transportation needs, and consumer spending drive up oil consumption. In contrast, recessions tend to see a fall in oil demand due to reduced industrial output and transportation activity. This elasticity not only underscores oil's economic relevance, but also its sensitivity to macroeconomic conditions. Furthermore, sectoral analysis within economies shows that sectors such as transportation, which accounts for a significant share of oil use, are often the most indicative of economic health. Fluctuations in oil demand in these sectors frequently predate broader economic shifts, serving as a leading indicator for economic analysts and policymakers. The insights from correlation analyses are crucial for formulating economic policies, especially in countries heavily reliant on oil exports or imports. They help in forecasting economic trends and preparing for potential economic shocks related to oil price volatility or supply disruptions. Understanding these dynamics allows governments and businesses to strategize more effectively, balancing economic growth ambitions with energy security and sustainability concerns. To illustrate the practical implications of oil demand on economic growth, examining specific case studies offers valuable insights. Two pertinent examples are Saudi Arabia and Norway, nations that have historically depended heavily on oil but have shown different trajectories in terms of economic stability and growth due to their varying approaches to oil revenue utilization and economic diversification. Saudi Arabia has been one of the world's largest oil producers and exporters for decades. The kingdom's economy is heavily dependent on oil, with approximately 50% of its GDP and 70% of export earnings derived from the petroleum sector. This dependency has exposed the Saudi economy to significant risks, as vividly demonstrated during periods of low oil prices. For instance, the 2014-2016 oil price slump led to budget deficits and economic slowdowns, prompting the Saudi government to initiate the Vision 2030 program aimed at economic diversification and reducing oil dependency. This case highlights the challenges faced by economies that are excessively reliant on oil, emphasizing the need for diversification to stabilize economic growth. Norway, on the other hand, presents a contrasting scenario. Despite also being a major oil exporter, Norway has managed its oil revenues more prudently. The establishment of the government pension fund Global, a sovereign wealth fund into which a significant portion of oil income is deposited, exemplifies this approach. The fund's resources are invested internationally, and only a small fraction of the fund's return is used to finance public expenditure. This strategy has allowed Norway to buffer its economy against oil price volatility and maintain stable economic growth, while also investing in infrastructure and public services that further contribute to economic stability. These case studies demonstrate how oil demand impacts economic stability and growth differently based on how oil revenues are managed and the degree of economic diversification. They serve as important lessons for other oil-dependent countries on the benefits of prudent fiscal management and the risks of over-reliance on oil. By learning from these examples, nations can better navigate the complexities of global oil markets and their impact on economic performance. The concept of peak oil, the point at which global oil production reaches its maximum rate before declining, has been a topic of intense debate among economists and energy experts. Initially, the focus was on the physical scarcity of oil resources. However, the discussion has shifted towards the economic impacts of peak oil in the context of evolving energy markets and consumption patterns. As we approach what might be the peak oil demand due to increased energy efficiency, the rise of renewable energy sources, and the global push towards decarbonization, the economic implications are profound. For oil-exporting nations, this scenario poses a significant risk, potentially leading to decreased oil revenues, economic instability, and challenges in funding public services and infrastructure projects. Moreover, peak oil demand could result in volatile oil prices as the balance between supply and demand becomes increasingly unpredictable. This volatility can adversely affect global markets and economies, particularly those still heavily dependent on oil. For importing nations, while reduced dependence on oil could mean lower energy costs and reduced import bills, it could also lead to transitional economic challenges as sectors tied to oil consumption adjust to new energy realities. To mitigate these potential economic disruptions, countries are increasingly focusing on diversifying their energy sources and economic structures, investing in alternative energy technologies, and enhancing energy efficiency across industries. This strategic shift not only prepares economies for a post-oil future but also aligns them with global sustainability goals. The global transition towards sustainability is reshaping economic growth models, with significant implications for oil demand. The drive for sustainable development is encouraging both developed and developing countries to reconsider their energy strategies, focusing more on renewable energy sources and less on fossil fuels, including oil. This shift is evident in national and international policies aiming to reduce carbon emissions and combat climate change. The Paris Agreement, for example, sets comprehensive targets for countries to decrease their carbon footprint, directly impacting the traditional economic reliance on oil. As a result, investments in renewable energy projects have soared, with solar, wind, and hydroelectric power becoming increasingly cost-competitive with traditional fossil fuels. The economic benefits of this transition are manifold. Renewable energy projects are not only crucial for reducing greenhouse gas emissions, but also for creating new job opportunities, stimulating technological innovation, and fostering economic diversification. Countries that are leading in renewable energy technologies are setting themselves up as pioneers in the new energy economy, which is likely to dominate the 21st century. Furthermore, sustainability initiatives are also focusing on enhancing energy efficiency, which reduces overall energy consumption and lowers the economic burden of oil imports for many countries. Improved energy efficiency across transportation, industrial processes, and building sectors can significantly contribute to economic savings and reduce environmental impacts. However, the transition to a sustainable economy also presents challenges, particularly for regions heavily invested in oil production. These areas face the dual task of managing declining oil revenues and restructuring their economies to adapt to new market realities. The success of this transition heavily depends on strategic planning, investment in education and technology, and international cooperation. In conclusion, as we look towards the future, the relationship between oil demand and economic growth is set to undergo profound changes. The shift towards sustainability not only promises to redefine how economies operate, but also challenges traditional economic paradigms. By embracing these changes, nations can ensure resilient economic growth that aligns with global efforts to forge a sustainable and inclusive future. This essay has thoroughly explored the intricate relationship between oil demand and economic growth, affirming the substantial impact oil has on global economies. From historical perspectives highlighting oil's role as a catalyst for industrialization to current trends signaling a shift towards renewable energy and electric vehicles, it is clear that oil's influence permeates every facet of economic development. However, as we have seen, this influence is evolving in the face of new economic and environmental realities. The historical analysis underscored the dual nature of oil in the global economy, as both an enabler of growth and a source of vulnerability. Events like the oil crises of the 1970s and 2008 have vividly demonstrated how fluctuations in oil prices and availability can precipitate widespread economic turmoil. Such episodes have not only shaped economic policies, but have also instilled a cautious approach towards oil dependency in many nations. The examination of current trends revealed a significant shift in the dynamics of oil demand, primarily driven by the rise of renewable energy sources and innovations in technology, such as electric vehicles. This shift is altering the traditional patterns of oil consumption and has significant implications for both oil exporting and oil importing countries. As these nations navigate the challenges and opportunities presented by these changes, the strategies they adopt will critically determine their economic stability and growth. Furthermore, the discussion on economic diversification illustrated effective strategies that nations are employing to mitigate the risks associated with oil dependency. Countries like Saudi Arabia and Norway have taken proactive steps towards diversifying their economies, reducing their vulnerability to oil market fluctuations, and preparing for a future where oil might not be as dominant a force in the global economy. Looking ahead, the concept of peak oil demand presents both challenges and opportunities. While it poses economic risks for oil-dependent nations, it also offers a chance to transition towards more sustainable and diversified economic models. The global push for sustainability is encouraging this shift, promoting a move away from fossil fuels towards a more resilient and environmentally friendly economic framework. In conclusion, the relationship between oil demand and economic growth is complex and multifaceted. As global economies continue to evolve, the role of oil is also changing, necessitating strategic adaptations to ensure sustained economic growth. By embracing the transition to renewable energy and pursuing economic diversification, nations can safeguard their economic futures while contributing to global sustainability efforts. The lessons learned from past experiences with oil should guide future policies and strategies, enabling a balanced approach that supports both economic development and environmental stewardship. This nuanced understanding of oil's role will be crucial as the world navigates the uncertainties of the 21st century, aiming for a sustainable and prosperous future for all.